Today's video, I'll discuss how much tax we have to pay in US. If you are already in India, you can consider it as a decision making, like how much amount you are getting in US and how much amount you will actually get at home. And if you are already in US, I'll explain how what are the ways and how you can save the taxes, the major options you have to save the taxes. uh, like we all always have to be concerned about the taxes we pay, because this is the largest. If you consider like in your salary, what is the most expensive thing, or what is the what is like where you have spent the most, so that will you will find that the taxes is the most uh, like expensive thing you pay from your salary. So I'll discuss about 3 4 major options. Like one is 401k, another one is Roth IRA, HSA and FSA. And then I will also like use a calculator to see if we try to save the taxes, like how much we'll actually pay. And also will show like what are the tax brackets here, and what are the different taxable components, what are the different taxes we have to pay, uh, and like what is the relevance of them. So this is the first one. This is the 401k. So this is the best way actually to save taxes in US. This is the most friendly and use, and like this is the max. This can help you save the most amount. So if you can see, like for 401k limit for 2013, so the financial year for US is the calendar year from January to December. And in 401k, the limit is $22,500 for this year. So what does that mean is, you can contribute. So this is like the retirement corpus you generate. So 401k, giving a very brief explanation on it. So 401k is a retirement plan where you contribute something from your salary, and something is also contributed from your employer. So if you are a salary employed, something your employer will contribute, something you can contribute. So 2000, like 22,500 is the limit from your end. Above that, your employer can contribute. Like in Microsoft, I am in Microsoft, so Microsoft contributes 50% of whatever I contribute. So let's suppose I contribute $15,000 in 2023, the Microsoft will contribute 7,500 for me, and that belongs to me now. That So I can use it in my like retirement age. I'll discuss more about how 401k works. um, what happens when you, what age you can actually take out the contributions. If there is penalty if you take out the contributions before, what if you want to move outside US before your retirement and you want to take out the contribution. I'll discuss all those, but for this video I'll keep the discussion to how you can save the taxes in US. W- because like how like if you are like suppose earning 150k 200k, I'll show you how much taxes you'll paying and how much taxes you'll actually save if you use these instruments. So for 401k, the limit is 2,500 as I said for 2023, and above that your employer can also contribute. So there is two ways you can contribute to 401k. One is pre-tax, another one is Roth. So Roth is nothing, just post-tax. So US gives you an option, like if you want to if you select pre-tax, that means you are not giving tax now, and you will have to pay tax whenever you are actually taking out your contribution. So let's suppose my salary is, let's suppose 150k, and let's suppose I contribute 50k, let's suppose 5k I contribute out of it. So on 5k I will not pay tax now. So my taxable income will become 1,45,000 dollars. And now for 5k I will not pay any tax. That will not be considered as my taxable income. But let's suppose that amount grows when I turn 60, 67, and that amount turns to $50,000. Now whenever I am taking out that money, uh, that will be counted as my salary for that year, and then the taxes will be applied. Another option I have is Roth, that is post tax, just another word for post tax contribution. So in that case, I'll contribute. So let's suppose my salary is 150 k dollars. Now let's suppose I say like my Roth contribution to 401k is $5,000. So first, my taxable income is not 145, my taxable is income is 150, but the money which I contributed to Roth 401k uh, can grow without taxes. So let's suppose after, like for hypothetical situation, let's suppose I paid all the taxes on 150k and the amount I have is 120k. Out of those, 5 I'll contribute to 401k, so I'll keep 115 and 5 will be contribute to 401k. Let's suppose at age of 60, that amount grows to $50,000. That time I don't have to pay any tax on it, that will be just tax free. So these are the two options for 401k. And yeah, so that's mostly it for 401k. You can save up to maximum $22,500 for 2023. It generally increase every year with the rate of inflation. So last year it was $20,500, but because the rate of inflation was too high in 2022, so they increased it little bit around 9%, 8% to 22,500. So the next option is Roth IRA. So every person in US can actually have a Roth IRA account, and you can contribute up to $6,500 in it per year if you have age of less than 50. And if you have like age of more than 50, you can contribute $7,500. Last year it was $6,000. That again increased by that 8.5% something because of inflation. Now, like six, so what is this now? So again, you will not save taxes today on it. There is no option of pre-tax in it like 401k, but you can contribute like whatever amount you taking home after tax cut, you can contribute to this maximum $6,500 per year, and this amount will grow untaxable. So whenever you want to remove it, there will be no tax taken from you. So these are the two very major ways you can save taxes. And yeah, and the third option is the third option is HSA. So what HSA is, its full form is health saving account. I'll come up. So this is like very broad instrument. I'll explain it further in any other video. I'll create a video on it. So HSA is health saving account. For now, like for the tax saving purposes, just know that if you make your contribution to HSA, the max you can go right now this year is 3,850, and for family 7,750, just double of it. So this amount you can only use for your health purposes, like in hospitals or buying medicine online and all, but you will save all the taxes on. So this is pre-tax. So let's suppose you earn 150k dollars per year, and if you contribute to HSA, that can only be used in the medical, for the medical purpose and all, on or just only for that, or buying medicine and all. And then your taxable income will become just 146.150. So that will be your taxable income. There is no option for Roth or post tax system in this one. uh, and like like we discussed till now, like at 401k, Roth IRA, and HSA. So you will have also a question like, okay, this money I contributed to it, but what will happen to that money? Will it be like a bank interest on it? Will it be uh, like something debenture type of it, or like how that money will grow? So for each instrument, there are different type of investments you can make, or different type of uh, uh, like there are different type of instruments you can invest that money and grow it. So I pulled that point up, especially for HSA. So many people think like we can grow 401k with the any index or any mutual fund. Similarly, for Roth IRA, I can do the CDs. So CDs is like fixed deposits, and I can do some stock investment and other options on it. I'll explain it further. In HSA also that is available. So many people think like for HSA we just have to keep that money aside, and we can't do anything about it. We can just use it for health purposes. That's not correct. You can actually invest it where it with the options provided to you by your employer, and there will be a lot of options like stock options, deposit options, and all that. And you can actually grow this money for your future medical purposes. Just advice, keep some amount uninvested, so you can actually use it in the case of some health or emergency. And then if you have surplus in it, you can invest it, and then you grow it faster for your old ages or later time. And also once you turn 60, so I'm giving importance to HSA, because many people just leave it thinking like HSA is just for health and we should not contribute. Once you turn 60, you can actually take out that money or contribution, whatever you actually invested or whatever money you have in HSA, like without any health purpose also. So concede, even if you don't want more money for say like saving money for your health or medical purposes, make sure you like keep it on the higher level, because this is just money you are growing without tax. And once you become old, you can actually use it for non medical purposes also. Yeah. And next one is FSA. So this is HSA. Another one is FSA. For FSA, it's very limited. So FSA, let's suppose your employer allows you like $500 per year. Now you cannot actually invest it, you cannot actually grow it. It's like $500 per year you contribute. You have to use that 500 that year, or they will become zero next year. So there also you save the tax, that is also pre-tax. So let's suppose you invest 500 in FSA, so your taxable income will become 1,49,500. There will be no tax on 500, but that 500 will become zero next year. So uh, that's not a very useful tool to save taxes. But you can also consider that if you pre-know that these will be the health expenses for me. So FSA is also like just part of similar to HSA. You can only spend it on the health things, and you cannot invest it, you cannot grow it, and you cannot take it forward to the next year. So these are the major instruments or tools you can use to save taxes in US if you are employed. And coming to the tax brackets, so let's suppose considering, let's suppose your taxable income is something X. Let's suppose your taxable income after everything you do is like 1,45,000 dollars. So you have to consider this chart for 2023. If you are if you are married and you are filling together, then the tax bracket will be different for you. If you are filling separately, then the tax bracket will be different for you. uh, so so if you are filling jointly, just make okay, so make sure if you are married and you both earn, or you don't earn, make sure you try to fill jointly, because filling jointly will always help you save taxes in US. So if you can see here, if you fill like as single, so you can see the brackets are like $11,000, 44,725 and all. But if you fill uh, like with your spouse, the tax bracket becomes double. So it will actually help you save taxes if any one of you is earning less than the other person. If you are both earning equal, then it does not make any change to your taxes, but that rarely happens, like if both are earning the same amount. Also, if let's suppose you are head of the household and your spouse don't earn anything, then also you will get the benefit. Then also you'll get the benefit of your spouse not earning. So you will come in the head of house tax brackets, and the brackets will be like little different, little liberal for you, not as a unmarried person filling the taxes. So the tax bracket will be higher for you, means like you will be paying less taxes. So consider you are filling as single, just for simplicity. So the tax brackets are like you will pay 10% of income here. And then let's suppose your income component 11,000 to 44,725, you will pay 1,100 plus 12% of the amount. Let's suppose for the amount above 44,725 to 953 375, so 5,147 is from the previous brackets, and then 22% on whatever amount you have. So this is how you can calculate the what taxes actually you will be paying. And let's use the calculator. So let's suppose you have the like let's suppose you have a salary of 150k per year, and you're filling separately, or you filling as an unmarried person. And let's suppose you contribute the amounts we mentioned. So let's suppose let's calculate that one. So let's suppose you contribute 22,500 to your 401k, 6,500 to your Roth IRA, 700 3,850 to your HSA, and let's divide it by 12. I'm considering the for 401k if you select the like pre-tax. And then you can see, so this was your salary, 150k salary. These are the deductibles, so you just take this amount home without paying any taxes on this. And then overall your taxable incomes become 1,03,306 rather than 1,050 like 150k dollars. So there are 3-4 taxable components in US. I'll discuss about them in a separate video, but majorly you will see federal income tax, so that will be $18,000 around. and there will be social security cut from your income. I'll discuss about the social security also. That, yeah, that's a very helpful tool here for your retirement and old age. And so the total tax you will see, or you paid around 29,600 here, and this is the amount you will get home plus whatever deductibles you have. So this much amount you will be paying in the taxes, and this much, like 83 plus 32 around, you will be getting home, and you will be paying around 29 k dollars taxes. So this is like very high level, how you can save the taxes here, how much you will be paying taxes. And you can consider it, like let's suppose you want to compare your country salary, and then the USA salary, how much you will getting, because like the salary can be like it's the thing matter is like how much amount we take home, right? Not how much company CTC is. So taxes become very important. And just remember, like taxes is the most expensive thing you will be paying in your entire life. So just consider saving taxes, and consider these tools. These are the most useful tools in USA. And yeah, I'll come up with the like explanation on 401k. It's these like tools have context their own, so it's they'll take like they deserve a video on their own, like on Roth IRA and HSA, so that will help also. Yeah, so thank you.